More than ever, the global economy is in danger of getting stuck in a temporary stagflation scenario. And on that front, the summer did not bring much relief. On the contrary, unprecedented droughts in Europe and parts of Asia and extremely low water levels on European waterways, for example, make it clear that the global warming poses more and more concrete risks to the global economy. And in addition, China's economy continues to struggle with COVID and is implementing new lockdowns, while the country's real estate crisis continues to expand. A slowdown in growth in the second largest economy is unlikely to be without consequences for the global economy either. But for European economies, it was above all Russia's closure of Nord Stream 1 gas pipeline that makes it painfully clear that the energy crisis is deepening and that the economic stagnation and in some cases even recession are now almost inevitable. Finally, for this crisis, one can no longer count on supportive monetary policies either. The statements of the main central bankers clearly indicate that they now give absolute priority to fighting inflation, even at the expense of a possible recession. Whether Europe's energy crisis will eventually result in persistent and critical energy shortages during winter, that remains an open question for the time being. Europe has been replenishing gas stocks at record rates and has reached the proposed 80% fill rate earlier than expected. And this provides some comfort, especially for countries with larger storage capacities. For instance, Germany and Italy, countries that were once highly dependent on Russian gas, already have margin that spans now over 70 days of winter gas consumption. Belgium, on the other hand, has much smaller gas reserves, between 10 and 20 days, but then has important LNG terminals that ensure the gas supply. Now, despite these gas reserves, additional measures are necessary to bridge the winter and to ensure gas supplies also in 2023. The substitution of Russian gas by other energy sources remains crucial, as does the drastic reduction of gas and electricity consumption. And finally, a unified European gas market that addresses the existing bottlenecks must also be addressed if more localized energy shortages are to be avoided. The EU, and in particular the European Commission, has an important role to play here. Now, but even if we manage to avoid these critical energy shortages, this will happen at the cost of extremely high energy and then especially gas prices. The European gas price rose to unsustainable levels of more than 10 times the normal price, while futures prices are also at an all-time high. European energy-intensive sectors are thus facing a very difficult period. Energy prices are not only threatened to remain high for an extended period of time, but are also many times higher than prices in, for example, the US. Now, if such competitive disadvantage continue for a long time, they could threaten the European industrial fabric. High time thus for a European action. The economic growth outlook is therefore certainly not rosy, and in line with our earlier projections, we are assuming a stagnant global economy. We expect a sharp decline in growth in the coming quarters, particularly in the European economy. Recessions in certain countries can certainly not be ruled out. Just think about Germany and potentially also about the US. We therefore expect growth to grind to a halt for the rest of the year and look forward to a period of low growth in 2023 as well. For the Eurozone, we expect average annual growth for 2023 to fall to approximately 0.3%, while the US is also looking at low growth close to 1%. But risks are clearly to the downside, especially in Europe. In case of critical energy shortages and severe rationing, Europe is heading for a deep and dangerous recession with significant welfare effects. And moreover, such a scenario is certainly not a tail risk. Finally, a quick solution to the inflation problem is not yet in sight. Headline inflation remains stubbornly high. For example, inflation stands at 9.1% in the Eurozone and at 8.3% in the US. Moreover, this inflation, and then especially in Europe, still seems to be broadening. We expect inflation to remain high, certainly in the coming months, while for the US there are some first weak signs that the inflation peak may have been reached. In Europe, in contrast, we expect inflation to remain high for the time being as a result of the energy crisis. Central banks now openly acknowledge that this inflation is indeed at an unacceptably high level and are well aware that their credibility is at stake. In very clear terms, they are now communicating their intention to tackle inflation quickly and vigorously, even at the cost of a recession. These so-called pivots are also being translated into action. Central banks, and in particular the Fed and the ECB, are accelerating the tightening of monetary policy at a record speed. The Fed already raised the policy rate twice by 75 basis points, and a third 75 basis points increase seems now underway, while also the ECB implemented the strongest rate increase in its history. This points to the determination of central banks to tackle the inflation problem and to abandon the typical gradualism in monetary policy adjustments for the time being. We therefore expect the interest rate environment to now evolve rapidly with further rate hikes that will soon move interest rates to a new equilibrium level. In short, little good news this summer. As expected, we are heading for a very difficult winter. An energy crisis and high inflation threaten economic growth, and central banks are determined to bring excessive inflation down to more acceptable levels. Risks of a deep recession are no longer tail risks, and governments all in all have limited policy space to fully absorb these shocks.